What's the secret to a tax-free retirement? Planning right now. The reality is that if you're in your 30s, 40s, 50s, and 60s, you better maneuver today. The tax code actually includes several moves you can make right now to create a future tax-free retirement income. But the optimal window may only last until 2026. That's right, there's really not much time to position yourself. Now, most people have a financial planning strategy to defer paying taxes wherever they can for as long as possible and hope for the best. But hope is not a strategy I would recommend. The problem is that many diligent savers, probably like you, are sitting on substantial tax-deferred retirement savings that could be a future tax bomb that explodes in your retirement. In fact, America's IRA expert, Ed Slott, recently wrote a book exactly about this problem. You were told to take advantage of your company retirement plan and defer taxes while you were working until your retirement, when you would be in a lower tax bracket because your income would be lower. Well, guess what? In many cases, that advice turned out to be completely wrong. Why? Did you know that many retirees have less earned income than during their working years, but pay more in taxes? It wasn't supposed to be that way. You know what astute financial planners advise their clients to do? We create strategies to maximize the after-tax growth and after-tax income for our clients. Because good tax planning is not about paying the least amount of tax this calendar year, it's about paying the least amount of tax over your lifetime. It's not what you make, it's what you keep. If you think tax rates are going to be lower in the decades to come, then move on from this video. But if you think that we are in for a higher tax rates, stick around. Colin X will be here, and I'm a certified financial planner professional with over 20 years of experience providing financial planning for business owners and their families that just makes sense. I own the financial advisory practice, Celestial Wealth Management, and provide advice virtually to clients all over the country. In my opinion, for many people, when you get to retirement, your taxes are going to be higher than when you are working. Let me say that again. Your taxes will be higher in retirement than when you're working. Let's first learn why. This is a good spot to point out important disclosures. The information in this video is for educational purposes. This is not specific financial planning or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any planning strategy. So why will taxes most likely be higher in retirement than when you are working? Well, many of the tax deductions that you have during your working years vanish in retirement. Student loan interest deduction. Well, that's gone. You've paid off those debts. Mortgage interest deduction. That's gone. You've paid off your home mortgage probably. Retirement plan contribution deductions. Those are gone. Health savings account deductions. Those are gone. Child tax credits. Well, I hope your children are grown and out of the home at this point. Adoption tax credits. Those are gone. The home office deduction. That's gone. And so are self-employment deductions. But for many, it's likely that withdrawing retirement savings to live on, where you have chosen to defer taxes through traditional retirement plans, will put you in a higher tax bracket than when you're working. That's why I call these potential ticking tax time bombs. Say that 3 times fast. Ticking tax time bombs, ticking tax time bombs, ticking tax time bombs. That is hard. Ticking tax time bombs. Look, when you defer tax payments today through a traditional retirement plan like a 401k, 403b, or an IRA, you will pay taxes in the future. In fact, I like to say a traditional retirement plan is actually a joint account with the government, not an individual retirement account. You know what's worse? In most cases, when you turn 72, you are required to take money out of those retirement plans whether you want to or not. And this results in required income on your tax return, just like a paycheck, whether you need the money or not. And if you forget to take it out, you are penalized 50% of what you were supposed to take out. Ugh. All right, now that you know what the potential tax problem is, let's figure out how best to fix it. In order to get to a tax-free retirement, the first step is to understand how Social Security benefits are taxed and then work to minimize or even eliminate their taxation. Most of us will be eligible for Social Security benefits, and for many retirees, they're like a nice baseline income during retirement. How much of a benefit you receive depends upon when you take the benefit and how much in FICA tax you paid in over your working career. If you haven't already, no matter what your age, you should apply for your online Social Security account. No, I didn't say apply for Social Security. All I'm saying is apply for your Social Security account. You see, years ago, we used to receive a Social Security statement annually from the government in the mail. It would tell you the amount of the benefit that you've accrued, what ages you can apply for it, and your income history. And this is important information for your planning. In order to get this information now, you have to create an online account. So first, go to socialsecurity.gov. Click on the Sign Up button. Then click on My Social Security. Then click Create an Account. And if you look right now, this is the information that you're going to need in order to open this account. All right, now that you have the account open and you can see what your benefits are, you also want to make sure you do analysis to determine the optimal time for you and your spouse to draw on Social Security. There are a number of strategies that can be employed to maximize the amount of Social Security that you receive depending upon your unique situation. But for many people, no matter what strategy they use, provisional income makes the Social Security taxable. That's right. In President Bill Clinton's first term in 1993, the Social Security tax was expanded so that up to 85% of your Social Security payment could be taxed. Well, what is provisional income, you ask? It's 1/2 of your Social Security income. Any distributions from your tax-deferred retirement plans, like traditional IRAs and 401ks, any 1099 capital gain or interest that's generated in your non-retirement investment accounts, any employment income, any rental income, and interest from municipal bonds. The IRS adds it all up and then computes whether your Social Security will be taxable. So how much provisional income can you have before your Social Security is taxed? Well, before we get to that, make sure you hit that little like button and of course, smash that subscribe button so you know exactly when I release the new financial planning video for this series. All right, as of 2022, here are the tax rates according to the Social Security Administration. If you file a joint tax return and your combined provisional income is under $32,000, you pay 0 tax on your Social Security. If your provisional income is between $32,000 and $44,000, you may have to pay income tax on up to 50% of your benefits. If your provisional income is more than $44,000, up to 85% of your benefit may be taxable. The numbers are slightly different if you're single, and you can check them out in more detail at ssa.gov. For a married couple, in order to keep your Social Security from being taxed, you would need to keep that provisional income below $32,000. Now, I know that may sound unrealistic, but it isn't. However, for some people, due to a pension or a large joint Social Security benefit, it will be impossible to keep Social Security tax-free. But for the vast majority of Americans, the key is to maximize the benefits in the tax code by planning now. What assets that you own and in what types of accounts you own them makes a significant difference in your future provisional income as well as your after-tax income. All right, now that we know what provisional income is, how do we keep it as low as possible in retirement? Well, first, we take advantage of the tax rates today before they are gone. Many people just don't realize how low tax rates are right now, but we can look back through history to give us some perspective. Before I actually looked up these rates, I too didn't really realize how low current rates really are. While today's top rate is 37%, many of us pay just 22, 12, or even 10%. This chart shows the top federal income tax rate by year going back to 1913. Look at the rates from 1941 through 1963. The top rates were over 80% and most were over 90%. Now you might say, well, that's just not me. That's only for the mega wealthy. Well, guess what? The other brackets were much higher as well. Right now, we have the lowest rates since 1992. The 2017 Tax Cuts and Jobs Act created some of the lowest tax rates for Americans in history, but they will not last forever. To create a tax-free income in retirement, it's important to understand where tax rates were, where we currently are, and where the sweet spot is. So let's take a look at these two charts side by side. The chart on the left shows the tax rates in 2017. The chart on the right shows the tax rates in 2022. For the purpose of this discussion, I am going to focus on the married couple rates that are in the middle. What you see is that for most Americans, once you exceed the 10% tax bracket, current tax rates are lower. The former 15% tax bracket is currently 20% lower at 12% of taxable income. The former 25% bracket is 12% lower at 22% of taxable income. The former 28% bracket is currently 14% lower at 24% of taxable income, and even the former 33% bracket is 5% lower at 32%. It isn't until you get to the 35% tax bracket that the advantage goes away. But what is really interesting is the changes to the income levels that allow you to be in certain tax brackets. What I want to focus on are the two large jumps in the tax rates, from 12% up to 22% and from 24% up to 32%. These are the big jumps to be aware of when creating your strategy. Let's take a moment to talk about the difference between income and taxable income. Most people roughly know what their income is, but they don't really know what their taxable income is. Taxable income is the income you are taxed on. Well, geez, that makes sense. It is the income after all of your deductions. This is an important number and can be much lower than your gross income. Also, in this country, we have what is called a graduated tax system. As you move into a higher bracket, you don't pay that higher rate on all of your income. The only income that is taxed at that higher rate is the income above the previous bracket. You know what is not taxed? That little like button. Likes are free, so make sure you hit that little like button, and of course smash that subscribe button, hit that little bell so you know when I release a new financial planning video in the series. Alright, now we are going to look at the tax rates for married couples. And if you're single, get married. Which, just kidding, but tax rates are much better if you are married, so maybe consider it. If you're single, the same principles apply, but you move into higher brackets at lower income levels. For the married couple, the first $83,550 of taxable income is only taxed at 12%. Once you have over $83,550 of taxable income, you don't move into the 24% bracket until you reach roughly $178,000 of taxable income. Compare that to the 2017 brackets when the income threshold for moving into that 24% bracket was a much lower $153,000. You know what's really wild? Well, wild for probably me and some CPAs who love this tax stuff, but it is interesting. Let's look at the difference between the current 24% bracket and the 32% bracket, the next big jump. Until you make roughly $340,000 of taxable income, you are still in the 24% bracket. Compare that to 2017. You can see that you jump into the 33% bracket at only $233,000. That's a $100,000 difference. It's a huge difference and is the largest sweet spot in the tax code. But how exactly do you design your current retirement savings strategy to maximize the standard deduction? When planning for your retirement, your tax-deferred retirement account balances should ideally be at a level where future required mandatory distributions, or RMDs as they're called, would be less than your future standard deduction. Got it? If you missed that and you didn't understand what I said, just hit that rewind button. Keeping your RMDs below your future standard deduction can potentially make your required distributions tax-free while also not causing taxation of Social Security benefits. Everyone's situation is different, which is why custom financial planning is extremely important. So how do we do it? This concept is actually pretty straightforward, so let's look at a hypothetical example. Marcia and Don are both 55 years old currently. They are 17 years away from mandatory IRA distributions. We are going to take the current standard deduction at age 65 of $28,700 and inflate it by a historical rate of 3% per year for 17 years. That standard deduction will be closer to $47,000 when they turn 72 and are required to distribute from their IRAs. So at 72, if they didn't have any other tax deductions or provisional income, they could potentially take up to $47,000 total from their IRAs without any taxes. But how much will Marcia and Don be required to take? Well, the IRS has a nice table to figure that out. This table is periodically updated, so you want to make sure you're using the current one when working through your calculation. If you're married, but your spouse is more than 10 years younger, congratulations. There's a special table for you. But for this example, Marcia and Don are the same age. At 72, their required distribution amount is basically 3.65% of their account balance based on their divisor of 27.4. Now that we know what they are required to take out, we can calculate the ideal total amount for Marcia and Don to have in their IRAs at age 72. So how large of a 401k or IRA could they have to distribute their required distributions tax-free? Drum roll, please. $1,287,800. You figure that out. In this calculation, $1,287,800 times 0.0365 equals $47,004. Or according to the 2022 IRS table, $1,287,800 divided by 27.4 equals $47,000. They both equal the same thing. Conceptually, a married couple, both over age 65, with no other provisional income could have just under $1.3 million total in IRAs, and the distributions would remain tax-free based on 2022 numbers. This is the starting point for figuring out the ideal amount of funds to have in a traditional IRA at age 72. Even if you had some provisional income, like say half of your Social Security benefits, you can create a strategy where distributions are not taxed or are minimally taxed. Just incorporate that provisional income into your calculations. And if you live in a state where distributions aren't taxed, even better. As of 2022, there are 12 states that you could live in that don't tax retirement account distributions. Take that into consideration when you're considering where to live. So this example figured out the ideal number with forward-looking planning. You may be thinking, okay, well, having little or no assets in traditional IRAs and 401ks is also a good move. Potentially putting all your assets in other account types and limiting your RMD amounts that way. Well, let's take a look at why this is not a good idea. Let's say Marcia and Don only had $100,000 in tax-deferred IRAs and 401ks at age 72. Their required distribution based on the tables would be $3,649. They would have $43,351 in unused deductions. That would be very poor planning. In my opinion, to get the maximum after-tax retirement income, you want to make sure you optimize the full amount of your standard deduction. Unfortunately, many retirees do not. Because my industry promotes the delay and pray strategy so much, many people don't plan properly in the earlier years. You figure that optimal number out for your own situation through these calculations. First, take today's current standard deduction and inflate that by the number of years until you reach age 72 with a future value calculator like one from this site, or good financial planning software like this one from Right Capital that I use. That will give you your forecasted future standard deduction when your RMDs start. That will be the ideal amount that you would want to withdraw from a tax-deferred IRA or 401k to minimize or even eliminate taxation of required distributions. In order to figure out the optimal amount to have in your tax-deferred retirement account, you would take that ideal distribution amount and multiply it by the retirement factor at age 72, which in 2022 is 27.4. That will give you your ideal tax-deferred retirement balance at age 72. Now, investment returns, RMD assumptions, and tax rates do change over time, so this is a living, breathing strategy that you would continue to monitor. It is not set in stone. Rather than delay and pray, plan optimally for your future. This is a video series about creating a 0% tax bracket in retirement, but you may have other provisional income that makes that impossible. Don't worry. The goal of financial planning in many cases is to maximize your after-tax income and wealth to reach your personal goals. Even if a 0% bracket isn't achievable in your situation, the upcoming strategies can still be used to drastically reduce your taxes in retirement and maximize your after-tax wealth. When you do that, you reduce the risk of running out of money in retirement, and you maximize the legacy you leave behind. Don't spend years accumulating assets just for Uncle Sam. All right, now that we know how to calculate the ideal amount to have in tax-deferred retirement accounts, let's talk Roth. Everyone loves Roth, except maybe the government that created them. More on that in a minute. So why does everyone love a Roth IRA? Roth IRAs have become so successful for some that the current government is looking at ways to cap access to them for certain people and to force distributions for others. So it's really important to be taking advantage of this strategy if it makes sense for you. Why does everyone love a Roth IRA? In 1997, the Roth IRA was created to allow people to put away money and forego a tax deduction. In exchange, you get tax-free growth and tax-free distributions. And if anything is left over after you pass away, your heirs can withdraw those funds tax-free as well. The government thought this was a great way to incentivize saving for retirement, as many pension plans were going away at the time. It also allowed them to collect some taxes right away. But many people who qualified still didn't contribute. People believe that they will be in a lower tax bracket in retirement, but that's a myth. Many people are in a higher tax bracket in retirement, given the combination of retirement income, those increasing RMDs, and Social Security. But not everyone can have these accounts. When these accounts were created in the late 90s, they were limited to Americans making less than $110,000 or $160,000 jointly, and annual contributions were limited to only $2,000. Well, fast forward to today. And now, if you make less than $144,000 in 2022 or $214,000 jointly, you can contribute up to $6,000 if you're under 50 and $7,000 if over 50. And if you do qualify, in order to have those tax-free and penalty-free distributions, all you have to do is have the account a minimum of 5 years and avoid taking earnings distributions until after age 59 and a half. All of your Roth IRA contributions can generally be accessed without penalty, so they can also act as an additional supercharged emergency fund. Forego the current income tax deductions of a traditional IRA or 401k deduction in favor of all the future tax-free growth of a Roth IRA or Roth 401k. When traditional 401ks and IRAs were created back in the 1970s, tax rates were much higher. In fact, here are the married filing jointly tax rates back in 1978. That's the year I was born. Just look at how much higher tax rates were back then. It made a lot more sense to take the tax deduction then and just hope for lower rates. It's exactly the opposite now, and is another reason allocating to Roth IRAs makes sense. What about when it's time to withdraw the funds? Are there the same requirements as traditional IRAs and 401ks? No. Roth IRAs are not subject to a required beginning date or a required minimum distribution. You never are required to take the money out if you don't want to. In fact, you can actually keep making contributions past age 72 if you qualify and still have earned income. But for many, an ideal strategy is to withdraw Roth assets in retirement. You know why? Well, of course, they're tax-free. You know why else? They don't count as provisional income and do not make Social Security taxable. This is one of the key points to a 100% tax-free retirement income. If you take away one thing from this video, it should be that Roth IRA distributions are tax-free and do not count toward the provisional income that can make up to 85% of your Social Security taxable. They are much more optimal to use in coordination with your traditional IRA distributions to keep your taxable and provisional income as low as possible. All right, the second part of the Roth strategy is to take advantage of the Roth 401k. Wait, Roth 401k? Did you know that most employers offer both traditional pre-tax 401ks and Roth after-tax 401ks? While they are available to over 86% of retirement plans, according to the PSCA's most recent survey, only 26% of participants actually make deferrals. Are you a solo entrepreneur? If you're making use of the solo 401k, you can also have a Roth 401k. Many solo entrepreneurs or partnerships still use the old SEP IRA where the only option is pre-tax deferrals. I would think twice about that. In fact, I created this video that explains the differences between a solo 401k and a SEP IRA in more detail. Check it out. The biggest difference between a Roth 401k and Roth IRA is that the Roth 401k doesn't have any income constraints attached to it. You can make $1 million of income and still contribute up to $20,500 in 2022 if you're under 50, and $27,000 if you're over 50 into a Roth 401k. That is a quick way to accelerate your tax-free retirement savings since you can contribute much more than the Roth IRA. The best part is almost anyone can do it. Roth 401k contributions can also generally be accessed without penalty, so they too can act as an additional emergency fund, a potential much better way to have an emergency fund than sitting in a low-yielding savings account. If you qualify, are married, over 50, and love this idea, here is how you and your spouse could get up to $68,000 in total contributions to this Roth strategy in 1 year. 2022 Roth 401k contributions. You put in $20,500 plus $6,500 as a catch-up, and you get $27,000 for you and your spouse. 2022 Roth IRA contributions. $6,000 in plus $1,000 in the catch-up equals $7,000 each. Total, that's $34,000 for each of you, or $68,000 for both, all in one tax year. Mind blown. But Colin, I'll be paying more in taxes now, and those funds will not get to grow for retirement. They are permanently lost. Wouldn't I do better to take the deduction now and have those funds grow pre-tax? This is an extremely common question, and I want to put to rest this concern right now. The number one factor here, by a mile, is taxes. The difference between the rate you pay now and the rate you will pay later. If tax rates remain the same or increase in retirement, using the Roth strategy will be better. It's not about inflation, earnings, or the opportunity cost. It is all about tax rates. If tax rates are the same at contribution and later in retirement, the end result would be exactly the same. Let's do the math. Here are the assumptions. We're going to start with a $10,000 contribution, lifetime investment earnings of 200%, and an assumed tax rate of 30%. As with any financial planning, we've always got to start with these assumptions, so that's why they're here. All right, here are the calculations. Traditional 401k contributions. You take a $10,000 contribution after 200% lifetime earnings equals $30,000. $30,000 times a 30% tax rate as you distribute the funds is $9,000 in taxes paid. So the net after-tax IRA balance from that initial $10,000 is $21,000. Now let's look at a Roth contribution. You're going to pay $3,000 in taxes up front, right? Because you have a $10,000 contribution going in times 30%, so you pay the $3,000 in taxes. Now you have $7,000 to invest. $7,000 after 200% lifetime earnings grows to $21,000, the exact same amount. That is because it's all about the taxes, and the taxes you pay in the beginning versus the taxes you pay at the end. Joel Dixon, Vanguard Group's head of enterprise advice methodology, told the Wall Street Journal in 2019 that the only factor to consider is current tax rates versus future tax rates. With Roth IRAs and Roth 401ks, you will never have to worry about the uncertainty of what future tax rate increases could do to your retirement savings. And because distributions are tax-free, they also can lower your retirement income to a level where there is less of a chance of hitting the Medicare premium surcharge known as IRMA, and it can keep your Social Security tax-free. For most Americans, but especially those who are in lower income brackets, say 24% and below, I think this is a significantly underutilized benefit if future tax rates rise. Creating a balance between tax-deferred balances and tax-free balances gives you flexibility as you approach retirement. I love flexibility. I would strongly consider an approach where you take advantage of both the pre-tax traditional 401k and the post-tax Roth 401k contributions. You can actually figure out the ideal amount to contribute to your pre-tax 401k and your post-tax Roth 401k with some basic calculations. To create your optimal tax-deferred retirement account, use a future value calculator like one from this site, or good financial planning software like this one from Right Capital that I use. You would input your current balance, the amount of years until you reach age 72, your annual rate of return, and then try different annual contribution amounts plus employer matches until you reach your optimal tax-deferred retirement balance. Then you can subtract that annual amount, your portion of it, not the match, from your annual contribution limit to determine the amount that should go into the Roth 401k side. Once you've maximized this strategy, if you qualify, you would want to make your annual Roth IRA contributions. This can help you create your very own 0% tax bracket in retirement by taking advantage of today's low tax rates. Whew, wow, that is a lot of information that I just covered. But the Roth strategy is so powerful, I want you to understand it. In order to maximize this Roth strategy, currently you can convert an unlimited amount of assets from traditional IRAs to Roth IRAs if you pay the taxes now. Now, there used to be an income cap, but that tax law was changed back in 2010 to allow anyone the opportunity to convert. That huge advantage may be slipping away. While we are still in these lower tax brackets, and while conversions are unlimited, it may make a lot of sense to convert assets and pay taxes now. Are you in an artificially low income tax bracket? because you sold your business? You semi-retired or are in between jobs? Are you under 40, building your career and still in a low income bracket? Are you retired but not yet claiming Social Security? Are you over the age of 59 and a half but younger than 72? Then you, my friend, are in the sweet spot for Roth conversions. You pay some tax now, but then have tax-free growth and distribution in retirement while building a tax-free legacy for your heirs. In my opinion, there is not a better time than now to explore how a Roth conversion can help your financial situation. Well, actually, there could be a better time. As I release this video, the stock market is trading just off its record highs. But if markets were to fall more significantly, it makes this strategy even better. You know why? You can convert assets while markets are down, pay the tax then, and then get the growth tax-free on the way back up. For those who converted in 2020 during the COVID pandemic, they look like geniuses right about now. From February to March of 2020, the S&P 500 fell roughly 35%. What if, at that time, you had your IRA, you converted the assets while the markets were down, and then as the market has rallied back and even beyond where it was, all of those gains are tax-free all into the future? I mean, if you did do that, kudos to you. But that's the type of strategy I'm talking about, and that could be the optimal time to do it. It's always tough to pay tax now. I get it, trust me. I want to pay as little as possible. But if the trade-off is pay a little bit now to not pay tax in the future, I will write that check all day long. But the real kicker here is that Roth IRA distributions don't count as provisional income, so they can't make your Social Security taxable. I'll say that again. Roth distributions in retirement do not make your Social Security taxable. Now, most of us will have Social Security income, assuming that it's around, in retirement. The delay and pray strategy employed by many allowed us to build up large pre-tax 401k and IRA balances. If you do nothing, when you retire and take distributions, those distributions will most likely make your Social Security taxable. The key to a 100% tax-free income in retirement is to begin positioning yourself now. By converting assets systematically over time, you can create a Roth IRA balance that can be withdrawn on your terms, not the government's, without taxes and without making Social Security taxable. So how do you pay the tax on a conversion? In most cases, Roth conversion tax will need to be paid from non-retirement assets. You can only do the conversion if you have money to pay the tax. That's generally why it's best to split up conversions over multiple years. And this is also the biggest reason why more people don't do conversions. It's nearsighted. If you don't pay the tax bill now while you're in these low tax brackets, you and your beneficiaries will most likely pay even more tax later on all the future growth and withdrawals as they push you into higher tax brackets. Another point to remember is the 5-year rule. If you are under age 59 and a half and convert assets to a Roth IRA, the assets that are converted must be held for 5 years before any withdrawals can occur. Otherwise, you are subject to a 10% penalty. Now, if you remember from Roth IRAs in the other videos, contributions can be taken out without penalty and without taxes. These on these conversions must be held in that Roth IRA for at least 5 years. So when can you pay the tax from retirement assets? Well, if you're over 59 and a half. You see, at 59 and a half, you can withdraw IRA assets without the 10% early withdrawal penalty. So you could do a conversion and then withdraw more assets to pay the tax. You have to be careful not to push yourself into a higher tax bracket, though, with the extra withdrawals to pay the tax. That's why, in my opinion, the best way to convert is to pay the tax with non-retirement funds. In my opinion, now is the time to consider converting your IRA assets. But conversions aren't for everyone. When doesn't it make sense? Here's a quick rundown of when a Roth conversion does not make sense. First, anyone that can't pay the tax on the conversion, because once you convert, you commit to pay the tax now. The second reason, anyone who believes that their future tax rates will be lower than their current tax rates. The third reason not to convert is if you have a low tolerance for volatility and want the assets to be in safe, low-yielding investments. Generally, it doesn't make sense to convert assets, pay the tax, and then not invest them in growth-oriented assets. The fourth reason is something that I like to call stealth taxes. These are taxes because a conversion increases your adjusted gross income. And you could raise your income to a level where you don't qualify for certain things, like medical deductions, or the IRMA surcharge on Medicare premiums kicks in, or you lose child tax credits and education credits, or the taxation of Social Security, or even the loss of the 20% QBI deduction for business owners. These are all what I call stealth taxes, and you want to be aware of them. But if these are triggered, it's often a one-time short-term expense to gain a much bigger benefit in retirement. The next reason you may not want to do a conversion, if you are applying for financial aid. The increased income from a conversion could impact it. IRA assets are generally excluded from financial aid assets, but the income from a conversion is not. So you may want to wait until financial aid isn't needed. Another reason you wouldn't want to convert is if you need the funds soon. If you pay tax now and don't allow the funds time to grow, then this strategy will backfire. Conversions are not for the short term. And the last reason that you may not want to convert is that generally if you are over 72 and subject to RMDs, your conversion window may be over. The only funds eligible for conversion would be those above the RMD. RMDs cannot be converted. And remember, RMDs are required minimum distributions. Notice that as I said this, I said generally, because in certain situations, conversions above the RMD can make sense. Ideally, if you have a younger spouse or beneficiaries that you plan to leave the assets to, then converting now, paying the tax, and allowing that tax-free growth for them may make a lot of sense. Every situation is different, so work with your tax and financial advisors to create your Roth plan before it's too late. HSA, or Health Savings Account. Health savings accounts are triple tax-free saving and investing accounts that are part of a high-deductible healthcare plan. These plans allow you to save and invest for the future by getting a tax deduction now on your contributions, tax-free growth if you invest the funds, and tax-free distributions if the funds are used for medical expenses. Huge benefits there with HSAs and a key part of the 100% tax-free retirement income strategy. You know why? Not just because HSA distributions are tax-free, but because just like the Roth IRA distributions, HSA distributions do not count as provisional income and do not make your Social Security taxable. In 2022, a family can contribute up to $7,300 into an HSA and $8,300 if you're older than 55. If you're single, you can contribute up to $3,650 with an extra $1,000 if you're over 55. And there aren't any income limitations. The higher your current tax bracket, the larger the deduction that you get. If you have the receipt for the medical expense, you can withdraw funds whenever you like without taxes and penalties, no matter your age. Even later on that day, make a contribution in the morning, pull it out later in the day. Now, once you reach age 65, you can withdraw funds for any reason without penalties, but you still would owe taxes like any other pre-tax retirement plan if you didn't use the funds for medical expenses. Stick around and I'll fill you in on a little-known secret that can allow you to withdraw funds for any purpose without taxes or penalties. All right, check this example out. Let's say you're named Ross Geller. You all know Ross from Friends. He's 30 and now he has a family. You have 35 years until he reaches 65. He decides to max out the annual contribution of $7,300 and the government never raises it. Let's also assume that he never puts in that extra $1,000 when he reaches age 55. So you just put in the $7,300 every year for 35 years. Let's also assume you invest the money in a diversified portfolio and net 7% a year. This is what that looks like. Your total contributions are $255,500. Your total gains are $824,277. Your total balance at age 65 is $1,079,778. And if you use that money for medical expenses, all of those distributions could be tax-free and penalty-free. If you use them for other expenses, you'd owe taxes, but not penalties because you're older than age 65. Now, I promise that secret strategy is coming. You know what makes me sad or really just a little frustrated? For many people who have HSAs, there isn't any growth. You might say, Colin, well, how can that be? Well, many people contribute to HSAs, but they miss the most important step, actually investing the money. According to a 2021 report by the Employee Benefits Research Institution, 50% of people employed have opted for a high deductible healthcare plan with an HSA. But only 4% of HSA accounts open for at least a year are investing their money. And after being open for 15 years, only 20% of those accounts are invested. What that tells me is that a number of people are aware of the tax deduction for contributing to it, but they aren't aware of the huge growth potential or just weren't told that investing those funds was even possible. It seems the vast majority of people contribute to the HSA, get the tax deduction, and then pull it right back out. Ah, man, if they knew. Proper planning can help you target a certain amount of growth in the HSA plan so that you cover your assumed health expenses in retirement. Once you reach age 65, you can withdraw the funds for any reason without penalty, but you don't want too much in there because if it isn't used for health care, you pay tax on the withdrawals like regular income. All right. Are you ready for that secret strategy to completely tax-free withdrawals without penalty? Here it is. There is no time limit on when you can claim the reimbursement from your health savings account. Really? Well, currently at least, I can track my medical expenses right now on a spreadsheet, keep the receipts, and then claim them in a huge lump sum later on in life for whatever reason. Because these expenses never expire. What type of expenses can you track? The list is literally endless. Here is a list that's compiled by Health Equity. I'll provide a link to it in the notes below. Look at this as we scroll through here. AA meetings, antacids, Botox, condoms, crutches, eye drops, fiber supplements, gambling treatment, infertility, a midwife, and many, many, many more. Seriously, it's almost anything you can think of that's medical related. And you know what? When I make that distribution, it would be tax-free and would not count toward my provisional income. You remember provisional income, right? Provisional income is all of that income the IRS adds up to compute whether your Social Security income is taxable. Now, I would never tell someone to spend all their time tracking all their medical expenses and logging receipts through their entire life. But hypothetically, if you tracked every bill that was over $100, that might be a very good way to help your future self. All you would need to do is create a spreadsheet in Excel or Google Docs, somewhere in the cloud that's backed up. List out the date of the expense, what it was, what the cost was, and confirm that it was HSA approved. And like we said, almost anything is. Then upload an image of the receipt to the file and move on. Wow, that is an amazing way to maximize your future tax-free retirement income, and a secret strategy that many people don't know about. The key is to make sure that you track those expenses and don't include anything other than those medical expenses when you pay for things. Most people think of life insurance for the death benefit, but there are many benefits while you are alive. Look, there is a lot about permanent life insurance I didn't know when I got started in the advice business. It's taken me years to learn the ins and the outs so I can easily understand how so many people run the other way when permanent insurance is brought up. Will the stock market implode like in the year 2000? I have no idea. It could triple from here, it could fall by 50%. No one knows. And if they say that they know, run the other way. After taking into account expenses for a permanent life policy, in my opinion, it could be a very attractive addition in this low interest rate environment. Will it outperform the stock market over time in a Roth IRA? Probably not. I really doubt it. That's why I've got a Roth IRA. But will it do better than having money in checking and savings accounts, CDs, or low-yielding bonds? It very well may, especially because it isn't taxed. If you earn 4%, just 4% in one of these policies tax-free, and we're in the 22% tax bracket, you would have to earn 5.128% before tax to do better. What bank account, CD, or bond is paying that? Now, many of us follow widely held truths without actually doing a little digging. Now, I am skeptical of almost everything, so the whole buy term and invest the difference strategy deserved a little more digging. First, when you buy a term policy, it is typically a level death benefit, like $500,000, $1 million, $2 million, which means due to inflation eroding its value each year, a term policy purchased decades ago is worth far less in inflation-adjusted dollars. Second, according to a Penn State University study, 99% of term policies never pay out a claim. Now, thankfully, most people don't need them and they let the policy lapse, but the dollars that are spent are gone forever. Third, how many people actually seriously invest the difference between what they would pay for a term policy versus a permanent one? Well, according to David Babel, a professor at the Wharton School of Pennsylvania, quote, "People don't buy term insurance and invest the difference. They most likely rent the term, lapse it, and spend the difference." Now that is American. For those that actually do invest the difference, what happens to the funds? Well, they typically go into an account where interest income is taxed and capital gains are taxed over time. Since 2000, the typical stock investor lost 49% or more of their savings not once but twice. According to the famous annual Dalbar study, the typical stock mutual fund investor earned 4.25% annually over the past 20 years ending December 31st, 2019. Now that's less if you're in the 22% bracket than what we talked about earlier. Over the same time period, the S&P 500 earned 6.06%. Now, you only got that return if you were invested 100% in stocks at all times and never panicked during those huge drops. And those gains are taxed along the way at whatever the government says that they should be taxed. Now, it's true that permanent life insurance policies can be more complex, and they can be more costly because of all the benefits that come with them. Also, not everyone is insurable. They are generally long-term planning vehicles and have policy premiums that need to be paid to keep the policies in force, whether through deposits or dividends. And if you withdraw cash, borrow, or use cash value to pay premiums, you do reduce the death benefit. It's also true that they are more inefficient in the early years as the policy gets going, but the longer they are held, the more efficient they become. It's kind of like an airplane flying from New York to LA. As the plane takes off from New York, it's full of jet fuel and takes a while to get up to cruising altitude. But once there, as jet fuel burns off, the plane gets more efficient and flies faster. It's the same with many permanent life policies. The longer they are in effect, the longer tax-free compounding of interest and dividends can occur. And if you structure these policies correctly with an agent that is looking out for your best interests, you can have a growing death benefit instead of a static one that benefits your heirs, and you can access the funds tax-free later on in life for that tax-free retirement income. How do you do that? You borrow against the policy value. Well, you must have to pay really high borrowing rates, right? No, borrowing rates are stated in the contract and typically 4 to 5% in this current rate environment. Hey, quick little plug here. If you're enjoying this video, make sure you give it a like, and of course, smash that subscribe button, hit that little bell so you know whenever I release a new financial planning video. All right, have you heard the saying, buy, borrow, die? That means buy assets, borrow against them to provide cash flow, and then die. Many wealthy clients implement this strategy to minimize taxes. When do you pay tax? Well, if you save in a non-IRA, you pay taxes typically at 15 to 25% of gains and potentially more if rates are increased. In retirement account distributions from IRAs and 401ks, you pay taxes if it was income, right? Typically double-digit rates, unless you're properly structuring your assets for a 0% tax bracket. So, is borrowing at 4 to 5% interest better than paying 15, 20, or 25% in capital gains tax? I think so. Permanent insurance structured correctly can be an excellent strategy for a tax-free retirement. Now, we just learned about all the benefits while we are alive, but what about passing on what we don't use? If you are diligent in your planning, you most likely will have assets that you would like to pass along to the next generation. Ideally, you want to do that tax-free and pass on as much after tax as possible. Well, when Congress unleashed the Secure Act in 2019, it eliminated the Stretch IRA. Man, Stretch IRA, that was previously around since the 1970s, and it made possible for those inheriting an IRA to take out proceeds over their lifetime, potentially lowering taxes. And I've got a number of clients that are utilizing that. Well, with the Secure Act, it says that you must withdraw all inherited IRA assets within 10 years unless you are a spouse or eligible designated beneficiary, or EBD as it's called. So, Congress just made traditional IRAs much less attractive to leave for beneficiaries. That's moved permanent life insurance to the top of the list for efficient estate planning. Now, do you have a spouse who will inherit your IRA at some point and then owe taxes in the single tax bracket once you pass on? Many couples forget that the odds are one of you will live longer than the other and will pay what is referred to as the widow's tax. The fact that you have the same income and assets but are now taxed as a single individual rather than married couple at much higher rates. And the government is counting on it. Wouldn't it be great to have an insurance payout that could help him or her convert those funds to a Roth IRA and pay the tax for them? I know I would love that. Roth IRA, HSA, and permanent life cash value for the tax-free win. You know what else is a win? Reverse mortgages. What are they? Why are they important to a financial plan? Who do they make sense for? And what to look out for? First, what is a reverse mortgage? A reverse mortgage is a type of loan that's designed to give people age 62 or over access to the equity that they've built up in their primary residence without having to sell it. To be clear, you can only get a reverse mortgage on the home you are living in. Unlike a regular mortgage in which the homeowner makes payments to the lender, with a reverse mortgage, the lender pays the homeowner. Now you have the option to receive a lump sum, a line of credit, or a series of payments over time, but you don't have to pay the loan back. You can if you choose to do so. It's nice to have that flexibility. You'll hear that word a lot. The loan balance accumulates interest over time similar to any other mortgage at the stated rate on the loan. And we will talk about how that impacts a financial plan in a little bit. The key part to understand is that the loan must be repaid when the borrower dies, moves out, or sells the home. And that's just like any other mortgage. Reverse mortgages are often called home equity conversion mortgages, or HECM for short. And they're administered and regulated by the U.S. Department of Housing and Urban Development, or HUD as many people know it. It's a great way to provide flexibility to a retirement plan. Since the distributions are a loan of your own home equity, guess what? They are not included in your adjusted gross income reported on your tax return. You know what that means? That means they don't count as provisional income. They don't trigger high-income Medicare premiums or the taxation of Social Security benefits. Huge. Government insurance is required and is provided through the Federal Housing Administration, or FHA. They're also a part of HUD. This backstop provides critical assurances to both the borrower and the lender. Insurance for an HECM reverse mortgage guarantees the borrower funds if the lender goes out of business. And it ensures the borrower will never owe more than the value of the home when sold. Let me say that again, since that is really important. If the housing market declines, the borrower will never owe more than the home is worth when it is sold. The borrower gets what is in effect a tax-free advance on their equity in the form of a line of credit, fixed monthly payments, or a lump sum. But the borrower must also continue to pay the real estate taxes, homeowner's insurance, and the cost to maintain the home, just like any other mortgage. All right, so why are reverse mortgages important to a financial plan? One word: flexibility. When you reach what I call the retirement red zone, the 5 years before retirement and the 5 years after retirement, you're in a very important zone for the success of your retirement plan. The ability to tap different assets to pay for retirement living expenses in a tax-efficient manner increases the success rate of your financial plan. For many retirees, a good portion of their retirement assets are socked away in tax-deferred retirement accounts like traditional 401ks and IRAs. I just talked with someone today about this. Over 90% of their assets are in these traditional 401ks and IRAs. Guess what? These assets have likely never been taxed. So what happens when you go to withdraw them? Well, when they're withdrawn, they're taxed at income rates and they contribute to provisional income. That can make Social Security taxable and increase your Medicare premiums. As retirees get close to and start drawing on these assets, the last thing that you want to see is a significant market downturn like what happened in 2000 to 2003 or 2007 to 2009. You probably remember those periods well, or at least saw your parents deal with them. Of course, there is no way to predict if or when a major stock market decline will occur. Why is this so important to avoid in your retirement red zone? Well, if stocks decline significantly and you're forced to sell them low because you need funds to live, you lose the ability to wait out their eventual rebound. For that reason, having an ability to access other assets, like a reverse mortgage, can help reduce the chance of running out of retirement funds early. In essence, if markets were down and you had access to a reverse mortgage, you could potentially use those funds, tax-free, remember, until the stock market recovers, and then tap the retirement accounts. You could even elect to tap those accounts and pay back the home equity you took out if you wanted to. There's nothing in a reverse mortgage that says you can't. A second reason reverse mortgages can be so important to a retirement plan has to do with the taxes and surcharges. These are what I like to call stealth taxes, because they creep up on you without realizing it. Currently, there are two significant jumps in the tax bracket at certain income levels, from 12% up to 22% and from 24% up to 32%. If your Social Security, pension, or other income each year comes to the middle of a tax bracket, and retirement account withdrawals would push you into a higher tax bracket, it can be beneficial to use assets like a Roth IRA and a Roth 401k or home equity through a reverse mortgage to keep your income out of those higher brackets. Paying loan interest can be a lot less than paying significantly higher taxes from creeping into a higher tax bracket. This is where sophisticated retirement income planning can potentially save you taxes at 22%, 32%, or even more. Who do reverse mortgages make sense for? All right, now that we know many of the advantages of reverse mortgages, let's discuss who they are most appropriate for. Actually, the better way to answer this question is to outline who they are not for. If this is not your primary residence, you cannot get a reverse mortgage. Second, if you are not yet 62 years old, you cannot apply for a reverse mortgage. And third, if you believe you're going to sell your home in the near future to move somewhere or downsize, I think a reverse mortgage on your current home may not be the best option because of the costs involved. So who do they make sense for? Ideally, they make sense for someone who plans to stay in their home for the rest of their life and is looking for flexible ways to access tax-free cash in retirement. First, if you are single, as I said, you must be over the age of 62 to qualify. If you're married, only one of you must be over the age of 62, but all borrowing qualifications will be based on the younger spouse's age. That's important if you have a wide age difference between the two of you. If you're married, it is mandatory that both of you are listed on the loan, but that's also good for financial planning purposes. Now, many times people think that using home equity is the last place you should go for retirement funds. I am here to challenge that thinking. I talk a lot about flexibility in my financial planning videos, and that's because we don't know what financial markets will do in the future, what unexpected health scares we will have, what tax rates will be, or what the world will have in store for us. Who thought we would have a pandemic? Not many people. So proactively creating access to various assets allows us to customize where we get funds in retirement and when. This can potentially lower taxes significantly in retirement and can allow you to avoid having to sell stocks to live on during a downturn. Even CNBC personality and PBS host Susie Orman recently said on her show that accessing a reverse mortgage is often a better option than selling stocks when they declined or paying capital gains taxes. Well, duh, that seems to make a lot of sense to me. All right, now that we know who a reverse mortgage candidate is, let's fast forward a minute. What happens when a reverse mortgage borrower does pass away? After a borrower passes away, the heirs take over the responsibility of repaying the reverse mortgage balance. Typically, heirs simply sell the house and use the proceeds to repay it. Proceeds from the sale of the home will always cover the entire repayment amount, even if the loan balance is higher than the sale price of the home. As a non-recourse loan, no other assets of heirs can be taken by lenders to repay the reverse mortgage. That is huge and an often overlooked part of financial planning. Now, while most heirs plan to sell their parents' homes, if the heirs prefer to keep the home as an inheritance, they only have to repay 95% of the loan. That's a nice advantage. All right, so what to look out for? Number one, watch out for pushy salespeople recommending a reverse mortgage without really knowing your financial situation. If it sounds like they're selling a reverse mortgage to anyone with a pulse, run as fast as you can the other direction. Work with a knowledgeable financial planner who knows your situation. Number two, scrutinize the costs of the loan so you know what they are, but don't dwell on them. I've seen a number of misinformed people talk about the high borrowing costs of a reverse mortgage as a reason not to pursue them. Well, as with any loan, there is an underwriting process to determine if the borrower has the financial means to pay for the loan. Traditional mortgage loans are known to have mandatory closing costs and fees, and reverse mortgages are no different. Both loans require expenses and closing costs, and since reverse and traditional mortgage closing costs include many of the same types of fees, the overall expenses are often very comparable. What is the major difference? The major difference is that reverse mortgage borrowers will often need to pay insurance on the loan to the FHA. This is what backs the loan if housing prices don't keep up with the loan value. In my opinion, it's a small price to pay for the peace of mind of not owing more than the home is worth when it's sold. Whew, that was a lot of content. I love helping people achieve their goals. Even more, I love how real financial planning can give people like you confidence, reduced anxiety, and a more fulfilling life without worrying about your finances. Now, when I say financial planning, I am not talking about some 125-page book that some investment firms sell you for a couple $1,000s that tell you some huge number that you're going to need for a successful retirement, and all it does is sit on a shelf in your basement gathering dust. I am talking about true financial planning, optimizing your cash flow, protecting you and your family from an untimely accident or an illness that can derail your finances, minimizing the taxes that you pay now and during retirement by efficiently building assets and efficiently distributing assets in retirement, keeping stealth taxes like those on Social Security and IRMA surcharges as low as possible, and determining the optimal way to build a legacy for your family. This is true financial planning. If you're watching this video, you're probably interested in working your way toward a 100% tax-free retirement. Is it even achievable? For many people, the answer is yes. For others, while the answer is no, there are many ways to drastically reduce the amount of taxes you pay to the state and federal government. Now, if you watched all the videos, you may say to yourself, this is amazing stuff. I'm going to start implementing these strategies right now. But you may not know where to start. You may not be confident that you're doing things correctly. You may not have the time to do it all yourself. Or most importantly, you may just want a coach with another set of eyes to help you along the way. Well, that is what I do. I've been helping people build their path toward prosperity for over 20 years through two of the biggest recessions in American history, as well as a global pandemic. If you think you're ready to supercharge your financial life and are looking for a coach to guide you, I would encourage you to visit my website at celestialwm.com. Click the button that says Start Here and book an initial 30-minute phone call. If on that call it looks like that you may be a good candidate, I will provide you with a link to create your very own free asset map. An asset map is a one-page visual representation of your financial situation. We will then schedule a second call to see if or how we can work together. Still not convinced? Check out these case studies in the resource section on my website. 3 examples of financial planning cases that are pretty typical of my work. If one of them feels like your situation, we should talk. Again, I hope you enjoyed this mini-series, How to Create a 100% Tax-Free Retirement Income. Taxes are often the #1 expense many people have. Let's craft a way to minimize your taxes through efficient financial planning right now. They say the best time to plant a tree was 20 years ago. And the second best time is today. Same thing with planning for your financial future. The comment I hear most often is, Colin, I really wish I put these plans in motion 10 years ago. Don't let that be you. Current tax laws are expiring in 2025, so the window for optimal planning is closing. Just click the link down in the notes to get started. Get clear, be clear.